Welcome back, Plutus people. What does a market order and bidding wars in the real estate market have in common? You will end up paying a lot more for the underlying asset and may suffer from a serious case of buyer's remorse. But staying true to our channel will make it very simple for you to have good knowledge of how to place orders in the stock market and save some money. More importantly, knowing all the different order types will empower you to make the most solid trades. So you have watched our last video about how to invest properly with Plutus's 5 principles. If you haven't checked it out, it will be right here and you can check it out and be ready for your first trade. Diving right into the different order types that you can use to buy equities and securities, we're going to break it down for you very simply, staying true to our channel again, as well as using examples from my trading career to see how I could have utilized those order sets to make myself a lot of money or save myself from losing a lot of money. At the end of our video, like always, we'll have ticker of the week. Diving right into the different order types that are available to us, we're going to the most common one, the market order. When you go log in and you try to buy a stock, under the order type, you will see a market order. It would say market. And as you pull up a security, let's say you looked at our ticker of the week from last week and you want to buy a Palantir. You look at the bid and ask. They will be 2 different numbers. So just to make it very simple for this, we'll use the example of a bid price of 10.20 and an ask price of 10.25. Now, if you place a market order, it will fill it at the most available price, which in most cases will be the bid price. So now we're going to talk about why that's not advisable. For a volatile stock, we're going to use the example of GameStop. When we're recording this video, today is the momentous day when the earnings came out, but that's an aside. Let's say you place a market order for 1 share of GameStop. The GameStop bid and ask could be anywhere from 164.15 to 165, and you don't know by the time your order hits the exchange what price you're gonna get. We have covered the most common order type, which is the market order, and we talked about why it's not advisable to use that order type in most of the cases. We're going to talk about the limit order, which is the type of order that I use the most when buying and selling securities or stocks. I'm using the big word securities here, but it just means stocks, ETFs, whatever you're buying. So let's talk about a limit order. And limit orders has made me a lot of money. I actively traded Tesla as my very first stock. And every morning when I wake up and I look at Tesla, I was day trading, I would set up a limit order for buying, let's say 10 shares at $500 a piece. So 500 was my limit that I was willing to pay to buy Tesla stock. So if the Tesla stock was trading at 505, my limit order would go in there and it was the maximum I was willing to pay for those 10 shares. And it also works when we're selling our securities. So now I have 10 Tesla stocks at $500 a piece for a total of $5,000. I want to protect my profit and sell these securities at $520 a piece to make a nice profit of $200 for the day trade. What I do is I go into my broker's page, I set a limit order at $520 for 10 shares, and it will execute when the price is at $520. This worked really well for me when I was busy and I could not just keep looking at the ticker all day long. Let's say the stock is trading at $515 and I would still set the sell price at $520. When it would hit $520, it would execute itself. And that's how you use limit order to your advantage. We have covered the market and limit order types. Now we're going to move into the stop loss order type. A stop order is used to sell a security when it reaches a specified value or a stop price. Simply put, you own a stock that is trading at $10 a piece. So I'm going to use my example from day trading today. So today I sold 200 shares of AMC at $10.80 a piece. But in order to make this very simple, we're gonna say I sold them at $11 a piece. I did not want the AMC price to drop below 11 and lose my profits. According to Plutus principle number 1, nobody ever went broke taking profits. So my average cost of an AMC share was $8.50. So I knew that I wanted to get out of this position at $11 a share. So I went in, I put my quantity of shares to be sold as 200, and then I put my stop loss order or stop price at $11 a share. So once the stock dipped below $11 or reached $11 mark, it triggered my order and I locked in a nice profit. You have mastered the stop loss type. But just to make things complicated, when you felt like you had a good control over the stop price or stop order type, we have to introduce you to the stop limit order type. Again, we're going over these order types so you can make your trading decisions with a very clear mind and not be intimidated. For myself, when I looked at the stop limit order type, I was so confused because it popped up two boxes for me. One was a stop price and one was a limit price. And I didn't know what it meant. I was like, what is going on here? And that kept on making me use just the stop limit order. But after watching this video, you'll be an expert at stop limit orders. So let's say you own Apple stocks at $120 a piece. You have 10 of those. You are a busy videographer and you don't have time to look at the stock market all day long. What you do is you expect Apple to keep on going up, but you also want to limit your downside or keep your profits, because also you are a Plutus subscriber and you know that nobody ever went broke taking profits. So looking at the stop limit order, you have Apple stock $120 per share. You go into your broker page, you set the order type as a stop limit order. It will populate two boxes for you. One would be a stop price and the other one would be a limit price. So your stop price in this case, you're willing to let the Apple stock go down to about 115 where you start panicking about your profit. So you put your stop price at 115. Now, as the Apple stock gradually dips from 120 to 115, your order type gets triggered. Your Apple share would not be sold for 115, but it's making your order become active, so to speak. So at 115, your order is now active, and that's where the limit box comes into play. You're willing to let go of your shares. You want to let go of your shares at $112 a share. So your stop order, your stop price got triggered at 115. Your limit price is 112. So as soon as the Apple stock dips to 115, your limit order gets triggered. And if it hits 112, it will sell those stocks. So you're willing to sell those stocks for $112 a piece or higher. Just to summarize, this is different from the stop loss order, because in the stop loss order, you only had one price. You had Apple at 120, but you're willing to let it go at 112. So you've just put your stop loss at 112 and there's no triggering of the order. It just sells it plain blank at 112. But in a stop limit order, the order only becomes active when the stock price dips your stop level, which is 115, and then executes it at a limit price that you have also set.